Have you considered entering the stock market, but been held back by fears of financial crises and economic downturns? There's a method to invest wisely and lower the risk of substantial loss: intelligent investing. Introduced by Benjamin Graham in 1949, this strategy advocates a long-term, cautious approach to the stock market, proven effective over time. Since the publication of The Intelligent Investor, many have followed Graham's principles to achieve significant wealth, with Warren Buffett being a notable example. Here, drawing from Graham's enduring wisdom, we offer a guide to help you start your journey as an intelligent investor. Before we delve deeper into this subject, if you'd like to get your copy of this insightful book, please check the description below. By opting to purchase through the link below, you'd be supporting my channel so I can continue making the videos you love. Thank you so much for considering. Let's dive in. Number 1. Intelligent investors exercise patience, meticulously evaluating a company's long-term potential rather than hastily jumping into decisions. Investing can be a gold mine, presenting substantial opportunities to grow wealth. However, it also carries significant risks, with countless instances of substantial losses. Financial history narrates tales of investors like Warren Buffett, who, through strategic selection of the right companies, have reaped enormous returns on their investments. Conversely, there are equally numerous, if not more, tales of woe, where individuals made the wrong investment choices and ended up losing everything. This raises a critical question. Is investing truly worth the inherent risks? The answer is that it can be, provided one adopts the methodical approach of intelligent investing. Intelligent investors are characterized by their comprehensive analysis aimed at securing consistent and safe returns. This approach stands in stark contrast to speculation, where investors chase quick profits from short-term market movements. Speculation is inherently risky, primarily because the future is unpredictable. As an intelligent investor, you would purchase a stock only if you are convinced that a favorable margin exists between the price you pay and the earnings you anticipate as the company expands. This margin of safety can be likened to shopping discerningly. For example, a high-priced dress is only a sensible purchase if its quality ensures that you will wear it for a considerable period. If the quality isn't up to par, opting for a more affordable option that lasts just as long makes more sense. The journey of an intelligent investor may not be filled with thrills, but excitement isn't the objective here. It's the steady, sustainable profit that truly matters. Number 2. Intelligent investing can be distilled into 3 fundamental principles. These principles guide the actions of all astute investors. Firstly, intelligent investors prioritize rigorous analysis of a company's long-term trajectory and core business principles before purchasing any shares. A stock's enduring value isn't based on whims. It is intrinsically tied to the performance of the underlying company. As such, it is vital to scrutinize the company's financial architecture, the caliber of its management team, and its history of paying consistent dividends, which represent a distribution of profits to shareholders. Resist the temptation to fixate solely on short-term earnings. Instead, cast your gaze on the broader context by reviewing the company's historical financial performance. Secondly, intelligent investors safeguard themselves from substantial losses through diversification of their portfolio. Never stake all your financial hopes on a single stock, regardless of its apparent potential. Lastly, intelligent investors maintain realistic expectations, aiming for stable and secure returns rather than astronomical profits. The goal for the intelligent investor is to satisfy her own financial objectives, not to outdo professional traders on Wall Street. Recognize that outperforming individuals who trade as their full-time profession is a tall order, and rapid wealth shouldn't be the target. Pursuing quick, substantial gains can lead to unbridled greed and imprudent decisions. Number 3. Intelligent investors recognize the critical role that the history of the stock market plays in informed investing. Before making an investment, the initial step shouldn't solely be examining a particular stock's history. While this is valuable, it is arguably even more crucial to delve into the broader history of the stock market itself. A retrospective glance at market history unveils a defining characteristic: consistent cycles of ups and downs. Consequently, it is essential to position yourself to withstand significant market downturns and emerge resilient. This underscores the importance of maintaining a diversified stock portfolio to mitigate the risk of simultaneous losses across your entire investment pool. Furthermore, it is vital to fortify yourself mentally and emotionally for potential crises. Resist the impulse to liquidate your investments at the first inkling of trouble. Instead, hold on to the understanding that, historically, markets have rebounded even after the most severe crashes. While it is impossible to forecast every market crisis accurately, studying market history offers insightful perspectives on its overall stability. Number 4. Avoid succumbing to the whims of the crowd and the fickle nature of the market. To grasp the capricious nature of the stock market, it may help to personify it. Imagine the entire stock market as a character, whom we'll name Mr. Market. In terms of personality, Mr. Market is erratic, highly emotional, and not particularly astute. Mr. Market is easily swayed, leading to dramatic emotional fluctuations. This characteristic is evident in the market's frequent oscillations, swinging from excessive optimism to unwarranted pessimism. Consider the release of a new iPhone as an example. Public excitement often reaches a fever pitch, and Mr. Market behaves similarly. This is observable in the stock market when an exciting event looms on the horizon. Prices escalate as people become more inclined to pay a premium. As a consequence, during overly optimistic phases concerning future growth, stock prices can soar to unjustifiable heights. Conversely, when the market sinks into excessive pessimism, it may trigger undue sell-off alarms. The intelligent investor must adopt a grounded stance and resist the temptation to conform to the masses. She should also learn to dismiss the erratic temperament of Mr. Market. Number 5. The portfolio of a defensive investor should be structured for stability and safety. As you embark on your investment journey, it's critical to select a strategy that aligns with your personal temperament and goals. You will need to determine whether you are a defensive investor or an enterprising investor. The defensive investor prioritizes risk aversion. Hence, safety is her paramount concern. Achieving this level of safety necessitates a diversified investment approach. First, consider allocating your investments between high-grade bonds and common stocks, which grant you a stake in a company and associated voting rights on key business matters. Aim for an approximate 50-50 split between the two. Or, for the particularly risk-averse investor, consider a 75-25 split favoring bonds. Bonds and stocks present varying levels of safety and potential returns. Bonds generally offer greater security but yield lower profits, while stocks, though riskier, can deliver more substantial returns. Second, ensure that your common stock holdings are also diverse. Opt for large, reputable companies with a track record of success, and strive to invest in at least 10 different entities to further mitigate risk. Number 6. Investing becomes straightforward when you adhere to a set strategy. Once you've selected the companies you want to invest in, the majority of your groundwork is done. The next step is to decide the amount you plan to invest regularly and periodically review your portfolio. At this point, embrace formula investing or dollar cost averaging, which involves consistently investing a predetermined amount of money at regular intervals, such as monthly or quarterly. For instance, decide to invest $50 every few months and buy as many shares as this amount allows. This approach is advantageous for its simplicity and discipline. It avoids emotional investment decisions, ensuring you neither overinvest nor take unnecessary risks. Number 7. To thrive as an enterprising investor, begin with strategies similar to those of a defensive investor. An enterprising investor is one that seeks to beat the market. Like a defensive investor, you will allocate your capital between bonds and common stocks. However, unlike the often 50-50 split favored by defensive investors, as an enterprising investor, you are likely to lean more towards common stocks due to their higher profitability potential, albeit with increased risk. Beyond the foundational bonds and common stocks, enterprising investors are open to exploring other, riskier stock options with potentially higher rewards. For example, consider an emerging startup that appears poised to become the next industry leader. Such an opportunity may be tantalizing, and as an enterprising investor, you might choose to take a calculated risk on this venture. However, it's imperative to exercise restraint, limiting such speculative investments to a maximum of 10% of your overall portfolio. Number 8. The enterprising investor doesn't follow the ups and downs of the market. When you own stocks and their prices fall, is your instinct to sell immediately or hold on? And when another stock is soaring, do you rush to join the fray before it's seemingly too late? Such reactionary behavior, or trading based on market fluctuations, is common among investors driven by the fear of financial loss when their decisions contradict the market's momentum. However, a savvy enterprising investor resists these impulses. Relying on Mr. Market's whims is perilous. If a stock's price is surging, it's likely that it's already inflated beyond its intrinsic value, or it's becoming a precarious investment. Recall the U.S. housing bubble in the recent past? People continually invested in real estate as prices soared, oblivious to the widening gap between these prices and the property's intrinsic value. When this disparity grew too glaring to overlook, the market collapsed. To sidestep such pitfalls, enterprising investors adopt a counter-cyclical approach, buying during market lows and selling during market highs. Conversely, market lows can present golden opportunities. Consider Yahoo Inc.'s 2002 acquisition of Inktomi Corp. At just $1.65 per share, a remarkable bargain. Mr. Market had soured after Inktomi's shares, once irrationally high at $231.62.5 per share during unprofitable times, plummeted. Yahoo capitalized on this market pessimism to secure a valuable asset at a fraction of its peak price. Number 9. The enterprising investor possesses the opportunity to uncover true investment gems. Is embarking on this journey as an enterprising investor, with its constant need for portfolio monitoring, truly worthwhile? Absolutely, for it is in this meticulous scrutiny that the most enticing bargains are unearthed. But savvy initiation is key. A prudent starting point for an aspiring enterprising investor is to practice with virtual stock pricing. Commit to a year of virtual investing to sharpen your ability to discern value and to track the trajectory of stocks without risking actual capital. Today, numerous websites offer platforms for simulated investing. Simply create an account to test your aptitude for securing above-average returns. This year-long trial serves dual purposes. It acclimates you to the nuances of investing and dispels any illusory expectations. With this invaluable virtual experience under your belt, you're primed to hunt for real bargains, often found in the stocks of undervalued companies. Whether you opt for a defensive stance or embrace the entrepreneurial approach, the key to navigating the stock market is to tread the path of the discerning investor. By adhering to the principles outlined here, you can steer your investments towards consistent and sustainable gains. Thank you for joining me in this journey today. If you'd like to get your own copy of the book, please click on the link in the description. Also, if you enjoyed today's video, please consider liking and subscribing. Until next time, stay calm and compound on.